Something remarkable happened in financial markets this year. Gold rose over 25%, hitting multiple record highs throughout the year. Silver surged nearly 35%, reaching levels not seen in over a decade. Reports indicate that gold hit approximately 40 new record highs during 2024. These aren't normal numbers. These are stress signals. Here's what most people miss. When precious metals print decade highs and sustain those levels, it's not just a price move. It's the market broadcasting that something fundamental has shifted in how participants view monetary stability. And when monetary confidence shifts, forced liquidation becomes the mechanism that redistributes wealth, often destroying people who are directionally correct but operationally vulnerable. Let me give you the math that makes this moment significant. According to various financial analysts, global debt reportedly sits around $315 trillion, roughly 328% of global GDP. Some sources suggest the world has added over $50 trillion in debt since the pandemic began. Global public debt reportedly reached $102 trillion, with the United States and China accounting for massive portions of that increase. If you understand those figures, you understand why metals at these levels aren't just trades, they're stress tests. A financial system can survive with large debt if settlement confidence remains intact. It can survive with massive leverage if collateral relationships stay calm, but when confidence wobbles, markets don't adjust gently. Price gaps violently because the system isn't discovering value through consensus. It's closing positions through force. Now I'm going to show you the pattern that repeats throughout financial history. 4 stages, chronological, universal, brutally consistent. Stage 1 is the setup. A credible system forms, trust accumulates, rules feel stable, money feels boring, people forget it can break. Stage 2 is expansion. The system creates more claims than it has backing. Debt expands, leverage expands, paper wealth expands. The expansion feels like prosperity, so it's celebrated. The system confuses more claims with more real wealth. Stage 3 is crisis. The math catches up. Maintaining the illusion requires increasing intervention. The cost of rolling promises rises. Liquidity becomes selective. Stress spreads. Stage 4 is outcome. Time runs out. Settlement risk becomes obvious. Real collateral reprices violently. Weak hands and over-leveraged actors are liquidated. And the public is told it was unexpected, even though the pattern was running in plain sight. That's the machine. Now I'm going to prove it 3 times in history with concrete years and concrete decisions. Rome. Early imperial Rome had a strong denarius. Under Augustus, the silver coin was widely trusted. Taxation and trade were organized. The empire expanded with monetary order. People believed the coin they held would buy roughly the same basket of goods next month. That belief is everything. Then the empire's obligations grew. Standing armies are expensive. Frontier defense is expensive. Political stability is expensive. Emperors constantly face incentives to spend because spending buys loyalty. The easiest way to spend without immediately raising taxes? Change the money. The silver content of the denarius begins to erode. Debasement accelerates. By the 3rd century, the empire is fighting a crisis of legitimacy and security. During the crisis of the 3rd century, emperors come and go rapidly, wars are constant, the state's need for purchasing power becomes desperate. The coinage becomes thinner, trust becomes weaker. The gap between face value and metal value grows. Debasement is hidden taxation. It takes purchasing power from holders of money and transfers it to the issuer. It's politically easier than explicit taxes, so it spreads. Once people recognize the coin has changed, behavior changes. Soldiers demand higher pay. Merchants demand more coins for the same goods. Tax collectors find nominal receipts, buy fewer real supplies. The state responds with coercion. Price controls appear. Hoarding appears. Barter grows. The system becomes tense, suspicious, increasingly authoritarian because the money no longer coordinates trust. In 301 CE, Emperor Diocletian issues the Edict on Maximum Prices, an attempt to control inflation through law. But laws cannot create trust. Laws cannot restore silver content. The edict is not a solution. It's a confession that monetary order has broken so badly the state is trying to command reality. The outcome? The money's social function fractures. People move toward real goods, land, food, direct exchange. The state tries reforms, new coinage, stronger enforcement, but the underlying damage is done. The empire limps on, but monetary deterioration contributes to the unraveling of economic complexity. Same 4 stages. And notice, the outcome is not a simple price spike, but a forced repricing of goods relative to a degraded unit of account. The denominator collapsed, so everything else looked like it exploded. Weimar Germany, pre-1914. Germany is industrial, organized, financially integrated. It has a functioning currency. The public trusts the framework. Money works, so planning works. World War I changes everything. States finance war through borrowing and monetary expansion because taxing the public directly for total war is politically dangerous. Germany expands credit and issues debt. Then the war ends, and the obligations do not. Reparations are imposed by the Treaty of Versailles in 1919. The state faces a classic bind: pay in hard terms and destroy domestic stability, or print and postpone the reckoning. The printing begins as temporary. It always does. By 1922 to 1923, pressure intensifies. The Ruhr is occupied in 1923 after reparations disputes. Germany supports passive resistance, which reduces output and tax revenue. The state prints to pay workers and obligations while production collapses. That's the moment the time function of money breaks. Hyperinflation is not merely high prices. Hyperinflation is the collapse of money as a reliable bridge between present and future. Wages are paid twice a day. People run to spend before prices change again. Shops reprice constantly. A loaf of bread that costs one amount at breakfast costs more by lunch. Workers don't ask for raises next year. They ask for raises next week, the next day. Money stops being a measuring stick and becomes a melting ice cube. The key mechanism is psychological and mechanical at once. Once people lose confidence that tomorrow's currency will buy roughly the same goods, they accelerate spending today. Businesses reprice faster. Workers demand higher wages. The state prints even more, which accelerates the loss of confidence. It becomes a loop. The system resets through a new anchor in late 1923. Stabilization arrives through reforms and the introduction of the Rentenmark, tied to real assets and supported by institutional change. But the losses are already allocated. Those holding nominal claims, cash, savings, bonds are destroyed. Those holding real assets or foreign currency survive better. The society's political fabric is permanently altered. Again, same four stages, ending in forced repricing and liquidation of people holding promises. The United States, Bretton Woods to the 1970s. This is the foundation of the modern system you live in, where the discipline of convertibility was replaced with the flexibility of fiat, and that flexibility became the seed of today's leverage machine. In 1944, Bretton Woods establishes a global monetary order. The dollar is central, and foreign governments can convert dollars to gold at $35 an ounce. The United States emerges with industrial dominance, large gold reserves, enormous trust. Trade expands. The system feels stable. As decades pass, obligations grow. The United States finances the Vietnam War and domestic programs, runs deficits, supplies the world with dollars. Foreign dollar holdings expand faster than U.S. gold reserves can credibly cover at the promised price. Same mismatch. Claims on collateral expand beyond the collateral. The London Gold Pool is created in 1961 to help maintain the $35 price by coordinating sales, but pressure continues. In 1968, the gold pool breaks and a two-tier market emerges. The system is signaling stress. By 1971, the mismatch becomes politically unsustainable. On August 15, 1971, President Nixon suspends gold convertibility, closing the gold window. The promise is stopped because it cannot be honored. That's the moment the anchor is removed. What follows is not random. The 1970s bring inflation and stagflation. Oil shocks in 1973 and 1979 amplify the disorder. Trust in purchasing power erodes. Nominal assets suffer. And gold, freed from the artificial peg, reprices violently, reportedly reaching around $850 in January 1980. The system stabilizes only by imposing pain to restore credibility. In 1979, Paul Volcker becomes Federal Reserve Chair and pushes interest rates sharply higher to crush inflation. This is essentially a controlled liquidation of excessive credit growth. Debt costs soar. Recessions occur. The economy is forced through a harsh reset to re-anchor expectations. Same pattern: expansion of claims, crisis of confidence, violent repricing of hard assets. Then a reset via pain. Now you have the mechanism. 3 proofs, 1 machine. Here's the present system in plain language. We built a global economy where growth is increasingly financed by expanding debt, and risk is increasingly managed through financial engineering that assumes liquidity and calm. We then trained ourselves to believe central banks can always smooth the cycle. That belief became the setup. The setup phase in the modern era is the post-1980 period of disinflation, expanding globalization, deepening capital markets. Money felt stable. Rates fell. Supply chains lowered costs. People internalized quiet faith. The system is sophisticated now. It won't break the way it did before. That was stage 1. It built trust. Then stage 2 arrived, expansion. After 2008, emergency policy became permanent policy. Rates were pushed toward zero. Asset purchases became normalized. Debt-financed growth became the default. Corporations learned they could borrow to buy back shares. Governments learned they could run persistent deficits. Households learned they could refinance. Markets learned a new religion. The Fed put the idea that intervention will always arrive to prevent collapse. When a backstop becomes expected, leverage expands to fill the space the backstop creates. Global debt at $315 trillion is not just a statistic. It's a fragile promise about future purchasing power and political stability. When debt grows this large relative to the economy's ability to service it, the system becomes sensitive to any shock that threatens confidence. Now, stage 3, crisis. Crisis in a modern system is often a creeping stress visible only in plumbing. Funding markets, collateral haircuts, volatility spikes, widening credit spreads, sudden rule changes. When the cost of maintaining the illusion rises, the system begins improvising. It creates facilities. It expands guarantees. It changes accounting. It encourages orderly behavior while quietly preparing for disorder. Then, something moves in a way that forces settlement. That's where precious metals come in. Metals are the simplest, oldest, most brutally honest collateral on Earth. They don't default. They don't need a counterparty. They don't need a central bank to be believed. They are not a promise. They are a thing. So when the system becomes nervous about promises, it migrates toward things. Here's the systemic revelation most people miss. In a stressed regime, markets don't move because people change their minds. Markets move because balance sheets change their constraints. When metals move sharply, it can be a narrative for retail investors. But for institutions, it's a margin event because precious metals are embedded in a web of futures, options, swaps, leasing, hedging programs. Bullion banks and dealers that make markets in metals carry exposures that must be hedged. When price crosses certain levels, hedging flows become compulsory. And when liquidity is thin, compulsory hedging looks like panic. That's how institutional buying pressure becomes real at the level of mechanics, even when no banker is screaming in a hallway. Now we apply the 4-stage pattern to 2024. Step 1 in the present is the setup. A world convinced that fiat currency is stable enough, that central banks can manage inflation, that derivatives can distribute risk. Institutions carry large bond portfolios and large derivative books because the system taught them these are manageable. The public trusts that price signals they see are real, not engineered by leverage. Step 2 in the present is expansion. Debt expands globally to $315 trillion. Claims expand through complex financial structures. The larger the count of promises, the more sensitive the system becomes to any asset that forces settlement. Step 3 in the present is crisis. Precious metals surge, gold up over 25%. Hitting approximately 40 new record highs in 2024. Silver climbs nearly 35%, reaching its highest level in over a decade. The moves reflect safe haven demand, geopolitical uncertainty, expectations of policy shifts. Those are not the characteristics of a calm system. Those are symptoms of a system whose participants are shifting from risk on optimization toward risk off collateralization. Step 4 in the present is outcome. A market where price moves fast, forces margin calls, and margin calls force liquidation. If you are short the move directly or through options exposure, you are not negotiating with your opinion. You are negotiating with your broker's margin department. And your broker's margin department does not care about your thesis. It cares about collateral. Let me make the liquidation mechanism painfully concrete. A large portion of market positioning is built on leverage. Leverage means you borrow exposure. That borrowing is allowed only as long as you post collateral and maintain margin. When price moves against you, your required collateral increases. If you can't post it, your position is reduced or closed. That is liquidation. Now add options. If you sold calls against metals, or if you sold volatility, you may be short gamma. When price rises, your hedging requirement rises. The higher it goes, the more you must buy to hedge. This creates a feedback loop where buying creates higher prices, which creates more required buying. That's why certain levels act like trapdoors. Metals printing decade highs after years of lower ranges is the kind of move that crosses multiple trapdoors. Technical breakouts, stop losses, option strikes, volatility triggers, risk limit thresholds inside institutions. And the institutions that matter most are not the ones tweeting about it. They're the ones quietly running large books and quietly avoiding public embarrassment. In these moments, behavior compresses into one action: reduce risk now. That's why liquidation events feel like a sudden storm. The storm was built by pressure that accumulated for years. To fully understand why this moment matters, you need to see the difference between a price rally and a repricing. A rally is when participants voluntarily decide an asset is attractive and buy it. A repricing is when the system involuntarily decides the old price was a lie and forces everyone to mark reality. Repricing is not a vote, it's a settlement. And settlement is always political because someone must take losses. In Rome, loss allocation happened through debasement, then coercion, then a shift into real goods. In Weimar, loss allocation happened through hyperinflation, then a reset that destroyed savings. In the 1970s, United States, loss allocation happened through inflation eroding purchasing power, then Volcker's rates forcing recession and debt pain. In every case, the losses did not vanish. They moved. In the modern system, the easiest way to move losses is still the same. Push them into currency and push them into time. But time is now expensive, and that's why metals are sending signals. The safe haven move into metals is not just fear of war or fear of recession. It is fear of the structure itself. It is a migration away from counterparty dependence. In a derivative-heavy world, the problem is not just whether price goes up or down. The problem is whether your counterparty survives long enough to pay you. This is why sophisticated actors care about non-liability assets. A non-liability asset is one that is not someone else's promise. Gold is the classic example. Silver becomes an accessible pressure valve that reflects the same instinct. Central bank buying patterns reportedly support this thesis. Central banks don't buy for sentiment. They buy for settlement safety. You might be tempted to say markets will pull back, things normalize. That sentence, things normalize, is stage 2 language. Stage 4 markets don't normalize, they reset. And resets come with rule changes. Let me show you the 3 biggest illusions people cling to right before a reset, and why each one is structurally false. Illusion 1. American exceptionalism means the dollar can't fail. The dollar doesn't need to fail for you to lose purchasing power. It just needs to be the chosen outlet for loss allocation. When a country has the reserve currency, it gains flexibility, but it also gains a temptation to use the currency as the sponge for debt stress. Reserve status is not a magical shield. It is a tool, and tools are used when pressure rises. Illusion 2. Growth will solve it. Growth helps only if it outpaces debt servicing and restores real purchasing power without requiring continuous credit expansion. But global debt at $315 trillion exists because growth did not solve it. Debt solved it temporarily by pulling demand forward. Illusion 3. Technology will save us. Technology can create productivity, but it cannot erase balance sheet constraints. It cannot prevent margin calls. It cannot turn an over-leveraged position into a safe one. And it cannot stop repricing when the system decides settlement matters more than narrative. Now, let's talk about what large institutions actually do in a liquidation regime, because this is where forced buying becomes a rational survival strategy. Banks and institutions manage balance sheets. Balance sheets have constraints, capital ratios, liquidity coverage, collateral needs, counterparty limits. When volatility rises and assets move sharply, those constraints tighten. In calm times, an institution can carry exposure because it assumes it can hedge and fund it. In stress times, funding becomes uncertain and hedges become expensive or unstable. So the institution reduces exposure, hoards collateral, and shortens duration. If an institution is involved in metals markets, directly as a dealer or indirectly through financing, leasing, or providing derivatives, then a violent move can force it to adjust hedges rapidly. That adjustment is buying pressure. And because it is constraint-driven rather than opinion-driven, it can look like panic. What makes silver particularly explosive is that it's a smaller market than gold with a history of volatility and a large presence of paper trading relative to physical. When price gaps, the paper structure is forced to reconcile with physical realities and collateral demands. This is not about conspiracy. It's about friction. Paper is frictionless until it isn't. Friction appears when too many people try to exit at once. That's what liquidation is. Everyone trying to exit through the same door. Let me give you the cold confirmation that makes this systemic rather than commentary. The setup was built in layers. First, the world moved from a constrained money to discretionary money after 1971, which increased flexibility. Then, the world deepened global trade and supply chains, which suppressed inflation for decades and made discretionary money look safe. Then, financial engineering expanded, allowing risks to be transformed through securitization and derivatives. Then, the 2008 crisis taught markets that emergency interventions would prevent collapse. Then the 2020 shock taught markets that fiscal and monetary expansion could be enormous and fast. Each layer increased the size of the promised network and reduced the perceived cost of leverage. That is the setup. Now expansion. Debt grows because it's the easiest way to maintain living standards, corporate profits, political stability without forcing immediate sacrifice. Global debt at $315 trillion is the consequence of decades of choosing later over now. Asset markets grow because cheap money inflates valuations and encourages risk-taking. This is expansion. Expansion always feels like genius until it hits a constraint. Now, crisis. Crisis in this regime means higher volatility, greater sensitivity to interest rates, more political tension around deficits, growing desire to move into non-liability assets. Metals surging to decade highs in 2024 is the visible symptom of that desire. The surge ties to safe haven demand, geopolitical uncertainty, and expectations of policy shifts. That's a crisis language. Now the outcome. The outcome is not one day. Outcome is a phase, cascading liquidation events, policy improvisations, accelerated repricing of real collateral. Metals at these levels are not just prices, they are boundary markers that tell you the system is entering the phase where old hedges and old assumptions break. If you want to know what comes next, understand the incentives of the people who run the system. Policymakers, central banks, treasury departments, the largest balance sheets, their incentive is not true. Their incentive is stability. And stability in a leveraged system often means sacrificing fairness to maintain continuity. That's why rule changes always come in stage 4. In Rome, the rule change was coercion, price edicts, forced labor obligations, tax in kind. In Weimar, the rule change was a currency reset and a political shift in who bore losses. In the 1970s, United States, the rule change was the end of gold convertibility and later the shock therapy of high rates. In the modern era, rule changes can look like new facilities, emergency exemptions, expanded guarantees, and if stress becomes severe enough, restrictions on flows or sudden changes in settlement rules. When promises exceed collateral, rule changes become the way the system redistributes losses without admitting it. Let me add one more layer to the present because the modern system didn't just get leveraged. It got leveraged in a very specific way by turning government bonds and central bank credibility into the core collateral of everything. In 2008, the crisis was sold as a housing problem, but the real crisis was collateral confidence. Mortgage-backed securities that were treated as high-quality collateral were suddenly questioned. Funding markets tightened. The system didn't nearly collapse because people feared losses. It nearly collapsed because participants stopped trusting what counted as good collateral. The response was a new doctrine. Central banks would manufacture liquidity against questionable assets to prevent liquidation spirals. That doctrine worked at a price. It taught every large institution that the worst outcomes would be mitigated. And that lesson doesn't make people safer. It makes them bolder. It encourages duration risk, leverage, accumulation of positions that only survive in calm conditions. Then 2020 arrived and compressed that doctrine into a single unforgettable demonstration. Fiscal deficits exploded. Central bank balance sheets expanded again. Markets learned that unlimited support was politically acceptable when the alternative was visible collapse. Once a society proves it will do something in an emergency, markets begin to price that behavior as a baseline. So by 2024, you have a world where the collateral hierarchy is absolutely central. Banks and institutions manage their liquidity coverage ratios and their high-quality liquid assets. They hoard the instruments that regulators and markets accept as top tier. They hedge rate and commodity risk through derivatives because it's efficient until it isn't. Look at 2024's moves again. Silver surged nearly 35% with moments of sharp acceleration. In a normal market, sharp moves are just trader complaints. In a collateral-driven market, sharp moves are triggers. They mean smaller flows can push price into levels where risk systems automatically react. Risk systems are not poetic. They are rules, value at risk limits, stress scenario thresholds, option exposure hedging, margin schedules, stop-outs, daily profit and loss constraints. The most dangerous moment in any liquidation regime is when those rules all fire at once. That's why you can see periods where metals don't just rise, they accelerate. It's the difference between a crowd walking uphill and a crowd being pushed down a staircase. Notice the psychological timing. The public usually asks, why did it move today? Institutions ask, what level triggered the rule? When a level triggers the rule, the why becomes irrelevant because the next few hours are dominated by forced action. This is how you get the phenomenon that looks like panic buying. Not a belief, but a requirement. This is also why the phrase liquidation event is more important than the phrase all-time high. The all-time high is the symptom. The liquidation is the mechanism. So when you hear someone say metals are rallying strongly, ask the deeper question. Driven by what and under what constraints? If the move is driven by forced covering and forced hedging, it can overshoot violently in both directions. In stage 4 markets, you can get melt-ups and then air pockets because the same leverage that forces buying on the way up can force selling when the next margin wave arrives. That's not fear-mongering. That's the structural nature of leveraged price discovery, which brings us to the hardest discipline in this environment, separating the long-term signal from the short-term trap. The long-term signal is that metals breaking to multi-year highs is a vote against monetary stability. The short-term trap is that the path between here and any new normal can be dominated by liquidation flows, which are unpredictable in timing and brutal in speed. So the disciplined approach is not emotional conviction. It is preparation for volatility. And that preparation brings us right back to the pattern, because the pattern doesn't just tell you what happened. It tells you how to behave. In stage 1 and 2, people are rewarded for leverage and optimism. In stage 3, people are rewarded for caution and flexibility. In stage 4, people are rewarded for being unliquidatable. That's the whole game. Your primary risk in a liquidation regime is not that you miss gains. Your primary risk is forced liquidation. Forced liquidation is how people who are right still go broke. You can be right in direction and wrong in timing, and leverage punishes timing. So the first actionable insight is mental, not financial. Stop thinking in narratives. Start thinking in constraints. Ask what would force someone to buy or sell regardless of price. What would trigger margin calls? What would trigger risk limit breaches? What would trigger policy response? When you can answer those questions, you stop being surprised by violent moves, and you stop interpreting liquidation as random. The second actionable insight is structural. Audit your own hidden leverage. Hidden leverage isn't just margin trading. It can be debt, long-duration bonds, overexposure to a single sector, reliance on continuous liquidity, or a portfolio that assumes calm volatility. In a stage 4 environment, the system is not forgiving. It punishes complacency because complacency is what allows leverage to expand. If metals can surge this dramatically in a year, then the old risk models that treat them as small diversifiers are already failing. And when models fail, institutions adjust abruptly. That adjustment is what creates the next wave of liquidation, because institutions don't adjust smoothly. They adjust when committees meet, limits are hit, and someone decides to reduce exposure quickly. Let me show you how a liquidation cascade often spreads. It starts with a trigger asset, something small enough to move fast, but connected enough to matter. The trigger asset moves sharply, causing losses in short positions or volatility sellers. Those losses trigger margin calls. Margin calls force selling of other assets to raise cash. That selling pressures correlated assets, widening spreads and raising volatility. Higher volatility increases margin requirements across the board. That triggers more margin calls. This is why liquidation events often spread from one market into others. The system is interconnected through margin. Now ask yourself what happens when the trigger asset is not a small speculative position, but a monetary metal that signals currency confidence. It's bigger. Because when metals surge, it's not only a profit and loss issue, it's a signal issue. It threatens the story that the currency is stable. And when the story is threatened, policymakers respond. Why does this matter for the specific observation that institutions face forced buying pressure? Because institutions are the intersection of all these pressures. They hold bonds, they fund businesses, they provide derivatives, they are judged by regulators and markets on liquidity. In a stress regime, institutions want collateral and liquidity. Precious metals are collateral, so if you see price behavior that suggests forced buying or emergency hedging in metals, it can be an early signal that parts of the system are tightening their posture. I want to strip away the romance and show you the machine in a simple equation. If total promises grow faster than credible settlement assets, then the system must either reduce promises through defaults and liquidation, which causes visible pain, or reduce the value of promises through currency debasement and inflation, which causes quieter pain. Modern systems prefer the second option until the first forces itself. When the first forces itself, you get liquidation events. Metals at these levels suggest the market is demanding a higher price for non-liability collateral and forcing those short that collateral to cover. Let's revisit the historical case studies with one more layer of insight. In Rome, the invariant was military and administrative obligations exceeded stable revenue, so money was degraded to fill the gap. In Weimar, the invariant was external obligations, and internal instability exceeded taxable capacity, so money was printed to fill the gap. In Bretton Woods, the invariant was global dollar claims exceeded gold collateral, so convertibility was suspended to fill the gap. In every case, the gap was bridged by altering the money or the rules. Today, the gap is global obligations exceed politically tolerable taxation and economically tolerable interest rates, so the system tries to bridge the gap through financial engineering, policy tools, and time. But metals are calling time. Here is the structural forecast. If this is truly a stage 4 transition, you will see more frequent impossible moves across multiple asset classes, more rapid policy improvisation, more public confusion as old models fail. And you will see a growing divide between paper representations of value and physical or settlement-grade representations of value. That doesn't mean the world ends tomorrow. It means the rules become less stable. How do you survive it? You survive it the same way people survived previous transitions, by understanding the machine early and by avoiding forced behavior. The people who got destroyed in Weimar were not necessarily stupid. They were normal citizens who trusted the system and held savings in nominal form. The people who survived better were not necessarily geniuses. They simply held assets less exposed to nominal destruction. In the 1970s, people who assumed bonds were safe experienced hidden destruction of purchasing power. People who held hard assets or inflation-protected exposures survived better. The lesson is not buy this asset. The lesson is don't confuse nominal stability with real stability. Let me build the present application even more systematically. Stage 1, modern setup. In one sentence, we built an economy that requires cheap credit and stable confidence to function smoothly. Evidence is everywhere. High debt levels, sensitivity to interest rates, policy reliance on liquidity. Stage 2, modern expansion, in one sentence. We normalized intervention and expanded leverage until the system's stability depended on the continuation of stability. That is the paradox. Stability breeds leverage. Leverage breeds fragility. Stage 3, modern crisis, in one sentence. The cost of maintaining stability rose through inflation risk, geopolitical fragmentation, funding stress, forcing participants to seek collateral and safety. Stage 4, modern outcome, in one sentence. The system begins settling accounts, not through polite repricing, but through liquidation events and violent moves in collateral assets like precious metals. Now address the emotional trap. When people see metals surge like they did in 2024, they either become euphoric or dismissive. Euphoria says, this is the new era, I'm going all in. Dismissal says this is a spike, it will mean revert. It's irrational. Both are emotional reactions. A systemic reaction is different. It asks, what does this price action reveal about the plumbing? And the answer is, it reveals the system is under settlement pressure. Here's a line you can repeat whenever you feel tempted to treat this like a casino. In a liquidation event, the why is less important than who is forced to buy, who is forced to sell, and who has no choice. That's the machine, and understanding that machine is your edge in navigating what comes next.